Welcome to Moat Main, hedge fund thinking for your daily life. If you make the wrong money decision in the next 6 months, there's a good chance you won't realize it until 2027. Because the Federal Reserve just made a move that sounds boring but could completely change mortgage rates, stock prices, job markets, and how expensive your life becomes. And here's the strange part. Two legendary investors looked at the exact same Fed decision and came to completely opposite conclusions. Ray Dalio says, prepare for volatility. Warren Buffett says, get ready to buy. So who's right? And more importantly, what should you do before the next move hits? This week, the Federal Reserve held interest rates steady. Again, that's the third straight pause. And on the surface, markets treated it like good news. But underneath the headline, something unusual happened. 4 Fed officials broke ranks. That's the most divided the Fed has been since 1992. And honestly, that should make people nervous. Because divided central banks usually mean one thing. Nobody really knows what happens next. Inflation projections were revised up, energy prices are rising again, and the Fed specifically warned about growing uncertainty tied to geopolitical tensions. Translation? Your groceries probably don't get cheaper. Your insurance probably doesn't get cheaper, and mortgage rates may stay painful longer than people expect. Meanwhile, markets are still pricing in future rate cuts. But several Fed officials are basically saying, not so fast. And that's where this gets dangerous. Because most people hear, the Fed paused. Smart money hears, the Fed may be trapped. And this is where Dalio and Buffett completely split apart. Ray Dalio built Bridgewater into the largest hedge fund on earth by obsessing over one thing: debt cycles. And Dalio would look at this Fed meeting and see something most people miss. Not strength, constraint. The Fed can't aggressively cut rates because inflation is still sticky, but it also doesn't want to keep tightening into a slowing economy. In other words, the Fed is stuck, and when central banks get stuck, volatility usually follows. Dalio has warned for years that late-stage debt cycles become unstable when debt is high, inflation stays elevated, and policymakers lose flexibility. Sound familiar? And this is why Dalio would not treat this Fed pause like a victory lap. He'd treat it like a warning. So what would Dalio do right now? Probably 3 things. First, build cash. Not because cash is exciting, because cash creates options. When markets panic, the person with liquidity has power. Second, avoid irreversible decisions. This is not the environment to stretch yourself thin. Huge mortgage, massive car payment, speculative bets. Dalio would say, don't assume today's conditions are permanent. And third, prepare for multiple scenarios. Most people build their lives around one assumption. Dalio builds around uncertainty. That's a huge difference, because the people who get destroyed financially usually aren't the people who guessed wrong. They're the people who weren't prepared to be wrong. But Buffett sees the exact same situation very differently. Warren Buffett is sitting on more than $300 billion in cash. And most people assume that means he's scared. But Buffett doesn't hold cash because he's fearful. He holds cash because he's patient. Buffett isn't waiting for optimism. He's waiting for stress. Because the best deals don't appear when everyone feels confident. They appear when somebody has to sell. And uncertainty creates forced sellers. That's why Buffett may actually love this environment. A divided Fed, sticky inflation, fear, volatility. That combination creates discounts. Buffett doesn't spend much time trying to predict what the Fed will do next. He focuses on something simpler. Is this asset worth more than the current price? That's it. And a lot of investors miss this. Buffett's edge is not prediction, it's discipline. While everyone else reacts emotionally, he waits, and then acts aggressively when price disconnects from value. So what would Buffett do right now? First, start shopping. Not buying, shopping. Know exactly what you'd love to own if markets dropped another 20%. Second, separate headlines from value. A scary economy does not automatically mean a bad investment. And third, treat cash like strategic ammunition. Buffett's cash pile isn't dead money, it's dry powder. He wants to be the liquidity provider when everybody else runs out of options. So who's right? Honestly, probably both. Because Dalio and Buffett disagree on timing, but they agree on something much deeper. Preparation beats prediction. Most people think investing is about being right, Dalio and Buffett know it's really about surviving uncertainty. The person who wins long term usually isn't the smartest. It's the person who built enough room to be wrong. That's the real mental model here. Margin of safety, not just in investing, in life. A cash buffer is a margin of safety. A valuable skill set is a margin of safety. Low debt is a margin of safety. Patience is a margin of safety. And right now, that margin matters more than it has in years, because the biggest financial mistakes usually happen during periods that look stable right before volatility returns. So here's your allocation for this week. Not theory, action. First, if you've been thinking about refinancing, get quotes. Not next month, this week. You don't need to lock anything yet, but know your numbers before the market moves. Second, if you're house hunting, stress test your lifestyle. Can you still comfortably afford that payment if rates go back above 7%? If the answer is no, that house is too expensive. Third, build your cash reserve. Seriously, this is probably the least exciting advice in the video, and maybe the most important, because cash buys time, and time prevents desperation. Fourth, create a shopping list. One stock, one business, one asset, something you would love to own at the right price, not because TikTok likes it, because you actually understand it. And fifth, invest in your earning power, because your career is still your largest asset. A stronger income stream creates more flexibility, more options, more margin of safety. The Fed controls interest rates, but you control your adaptability. Here's the truth. The Fed doesn't decide whether your future becomes stable. Your preparation does. Dalio prepares with caution, Buffett prepares with patience. But both are really saying the same thing. Don't wait for certainty, because by the time certainty arrives, the opportunity is usually gone. And the people who thrive during uncertainty aren't fearless, they're prepared. That's the difference, and that's the real lesson from this Fed meeting. So right now, which side are you on? Team Dalio, build cash and wait, or Team Buffett, build your shopping list? Comment one word, cash or shopping. I want to see where this audience stands before the next Fed move. And if you want more videos about applying legendary investor thinking to your actual life, subscribe. Moat Main hedge fund thinking for your daily life.